Welcome to GRE. I'm your host, Keith Weinhold. Is America in housing price bubble territory? Let's explore some indicators today. Prices, inflation, interest rates, cap rates, and what's happening to cash flows. Then we are going straight to the heart of a particular city that's one of the hottest real estate investment markets in America. Today on Get Rich Education. For accredited investors, if you've ever dreamed about making 10 to 12% of passive income annually, Wagner and Alasko and his partners of professional syndicators have the answer for you. Invest in one of the safest assets available on the planet, real estate. On a preferred return basis, you will collect your money before anyone else does. To find out more about these opportunities, visit I'mAccredited.com or text 305-684-2222 for your free investment guide. You know, a lot of investors choose either cash flow or home price appreciation, but one real estate market could provide both: Jacksonville, Florida. They've got 27% lower home prices and higher rents than the national median. Their market has appreciated 34% more than other comparable cash flow markets over the last 30 years. Get positive cash flow today and above average appreciation for tomorrow. They often have available inventory in Jacksonville, if you can believe that. Start at cashflowandgrowth.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Pittsburgh, Pennsylvania to Pittsburgh, Kansas, and across 188 nations worldwide. I'm Keith Weinhold. This is Get Rich Education. We are all about how real wealth is built in the real world with real estate. Are we in a housing bubble? First of all, is there one person that you could ask that question to that would know the answer? I mean, who really has the clairvoyance to know the future? Is it the HUD secretary? Or maybe it's the head of Fannie Mae or the National Association of Realtors or your local real estate agent? How about your state senator or a U.S. senator? How about me? Am I the one that has the answer? Would your elected officials know if we're in a housing bubble? Would your appointed officials know? What about Fed Chair Jerome Powell, Treasury Secretary Janet Yellen, maybe even Donald John Trump? Hey, he's a real estate guy after all. How about the actual person of one Joseph Robinette Biden Jr., our president? If you got a couple of these guys together, you could surely trust them to give you a clear-cut answer about home price direction or anything else. What do they say?
You should go out and vote. You're in voting now. Vote and let your senators know how strongly you feel. Vote now.
Are you going to pack the
Make
court?
sure you, in fact, let people know
He doesn't want
you're a
to answer the
senator.
question.
I'm not going to answer the question
Why
because
wouldn't you answer that
because
question?
the question
you want to put a lot of new Supreme Court justice, radical left.
Will you shut up, man?
Listen, who is on your list, Joe?
This
Who's
is
on your
so
list?
right,
gentlemen.
Oh, dear. I can see the video of this exchange while you're hearing it, and it only makes it all the funnier. Oh, I've got to regroup here. It is too early to cut to a commercial. Got to regroup and recoup here. That gem of an exchange is from the 2020 presidential debate. Hey, there you go. You just heard from the last two men that occupied the highest office in all the land right there. I'll bet that you've never been so proud to be an American. So, getting back to real estate, every single year, year after year, for I would say 10 years now, some people have been saying that home prices would go down. In fact, a few economists and influencers and contemporaries of mine predicted a housing price crash was coming in 2021. A lot of them really pointed to that year. I have never said any such thing here. You know that. I'm the one that informed you that a housing crash already happened. It occurred in April of 2020, and it was a housing supply crash. That's when this already low housing inventory failed to make its seasonal rebound when spring and summer of 2020 rolled around and the supply of available homes started falling off a cliff then. That was 2 years ago. But with respect to today's question, a price bubble or a price crash, let's define first what this is, because these synonymous terms of bubble and crash, they're somewhat nebulous. I think it's best to define this as a loss in price of 20% or more. And I think that's convenient because it is analogous to what's called a bear market when you have a loss of that much value over in the stock world. Now, let's start with the most basic and work our way up to the most layered here. Who out there would say that we are in a housing bubble because house prices must come down simply because they've gone up? Well, that's someone that really doesn't have much information. The more knowledge and context you have, the better answer that you have. So let's work toward that because, of course, it's not just prices. It's what is real estate's inflation-adjusted price. And this plays into the concept of what I call tilt the chart. If you're looking at any price chart and you see the price rise up and to the right of the chart, like a ramp does, if that chart doesn't say inflation-adjusted on it anywhere, then what you need to do is put your hands on that chart, take it, and tilt the chart clockwise a few degrees in order to turn nominal dollars into real dollars. That is the tilt the chart concept. But if someone's telling you about inflation-adjusted price, all right, at least they're thinking a little bit now. How about mortgage interest rates? They have been up sharply these past few weeks, and of course they're still historically low, but they're no longer super low. And that plays heavily into what buyers find affordable because people actually don't buy a property based on the price of that property. They buy based on the affordability of that monthly payment. If you want to get an idea for mortgage rate direction, look at the yield on the 10-year Treasury note. And by the way, do you have any idea what the long-term spread between these two rates is? Over the last decade, your 30-year mortgage rate is 1.7% higher on average than that bond yield on the 10-year T-note. Now, it's not 1.7% at all times. That's the long-term average. And sure enough, a few weeks ago, when mortgage rates spiked up high really fast so that they were a good 2.5% above the bond yield, well, that gave me confidence that the quick mortgage rate spike was over with. And then sure enough, the bond yield caught up. Recently, the bond yield was up to about a full 3%. And again, 30-year rates on an owner-occupied home average 1.7% more than that rate. Now, what's the other big factor that a lot of people think has something to do with home prices? And it does. It is one's personal income. American household income is higher than ever. HUD will tell you that it was nearly $80,000 last year. The census figure comes in lower, but still, note that income has had trouble keeping up with this heightened inflation. Now, sometimes I hear people say something like, home prices cannot rise faster than incomes. Well, of course, that statement is false. I mean, just look at what's happened with about 20% year-over-year home price increases last year. That helps reinforce my point. Incomes didn't rise that fast. Even if interest rates stayed the same, in areas home prices have risen faster than incomes, they are rising faster. They can continue to rise faster than an area's incomes. And there are a number of reasons as to why this happens. If a buyer has assets or equity, like the record equity position that Americans have now, they can use that to buy a property. See, buying a property doesn't need to be based on income, although a lender might look at that. It's based more on whether or not you have the down payment money or money to pay all cash. You could have zero income and pay all cash for a property. You don't need a lender for that. And another reason that house price gains can vastly exceed an area's income gains are the impact of foreign buyers in the real estate market. And they don't even need to be foreign. They just need to be out of area buyers. In fact, did you know that the impact of foreign money coming into their housing market made Canada recently impose a ban on this? Yeah. Just this month, Prime Minister Justin Trudeau's government has banned foreign homebuyers for 2 years, and this is in order to cool off the hot Canadian housing market. It's going to be interesting to see what effect that has. But when it comes to the low housing supply, this is really the big one. We need 3 to 5 times as much housing inventory, new housing supply, just to bring the market back into buyer and seller equilibrium. And you know why I often say keep your eye on the supply. That's because when supply is so low, that's what fuels bidding wars. 10 buyers or 30 buyers for one house means that the top offer will exceed the asking price, and that is the exact mechanism that pushes prices higher. If you want to know where it comes from, that is a direct mechanism. And if a lender appraisal comes in lower than the contract price, well, the deal doesn't get killed because the borrower will pay more than the overage. That's what they've been doing lately. What about supply and this hope that we might bring some more on anytime soon? I've called it inelastic because it's difficult to do. Advancements in 3D printed homes, they are not there yet. We dedicated an entire show here to why 3D printed homes are not bringing on supply anytime soon. How about tiny homes or shipping container homes? That's a cheap way to build. They are not the answer either. In fact, the guest that'll join us on the show later today did an episode with you and I here a couple years ago on why shipping container homes are not the answer and they're not feasible. There is a little good news, though, on the housing supply front now. Housing starts rose just a little last month, and that's fueled by more starts on the multifamily side. Single-family construction, it still really hasn't picked up, but it all just hardly makes a dent in this jaw-dropping undersupply. And in fact, the virus-related shutdowns in China this month threaten to create more supply suppression in the housing market since America gets so many of our materials there. So when I give you my answer about housing bubble prospects, well, let's look at my recent record with regard to all of this. In 2018 and 2019, back then, house prices were rising about 5% annually, and that's pretty commensurate with historic norms. And I said right here on the show at that time, so that was 3 to 4 years ago, I said that I really don't see what is going to make house prices go up much faster than this because we already had good GDP growth and low unemployment back then. But of course, no one saw the pandemic coming. 2020 came around, and you might remember it was a very weird time those first few months of 2020. And gosh, it was especially weird for me because I was visiting India and Sri Lanka in February of 2020. Then I was on to Arabia in March. In fact, I was still in Dubai as late as March 2nd, 2020. It was getting to be, a really weird time to be traveling as these COVID protocols were ramping up and starting to weigh me down. I returned to the U.S. and later in March and April of 2020, shutdowns were occurring. Layoffs were announced, and this created a ton of unknowns for a while, as you probably remember. And no one, me included, knew how these effects were going to ripple through the housing market right away. But at that time, I like to look at history. I did a few things. I researched the Spanish flu year of 1918 to try to get some guidance as to what might happen in the housing market in the midst of a pandemic, but I really didn't get any direction there. And then late in 2020 and 2021, this is when some of my contemporaries started calling for a housing price crash by 2021. And of course, they were all wrong. This is when we were into the era of mortgage loan forbearance and eviction moratoriums. And you heard me say here on the show, keep your eye on the supply. For the first time back then, Biden became president in January of 2021, and I told you shortly hereafter on this show that this administration does not want to let people lose their homes. So don't expect a foreclosure downdrain. So with that backdrop, let me be clear on answering the price bubble question. The prospect for this happening this year are low. Here on the show 2 weeks ago, I gave you 10 reasons for this. That was episode 392, and the name of that episode is Why Home Prices Are Soaring. So with national housing price gains of 18 to 20% last year, depending on what metric you're looking at, Case-Shiller came in around 19%. Expect a halving of 9 to 10% gains this year. So no price bubble expected this year, no crash, still faster appreciation than historic norms, though. Redfin has released some data that they now see early signs of a housing market slowdown. Now, that's not reflected in prices. Home buyer demand could be scaling back. Redfin shows fewer online searches for homes. Applications for mortgages are down over this period last year. I recently talked to a house flipper. Now, this is just one flipper in one market. And typically when they put a property on the MLS a month ago, they would have showings and offers right away. That's now slowed down somewhat. Now, this is a good long-term thing. It is not good for a nation when it can't adequately house its population. We badly need more supply. But yeah, real estate has been very good to us here, you and I, on the investor side. You are profiting from things that only make most people poor, like debt and inflation. With this heightened inflation, of course, it is really helping you out. I was just looking back at where we did our last GRE in-person real estate field trip. It was right before the pandemic in Tampa, St. Pete, Florida. And that one was a pretty intimate affair. We could only accommodate one tour bus that we took into these investor advantage neighborhoods north of Tampa, St. Pete. So we filled that bus with about 45 GRE listeners. And my gosh, since 2018 and 2019, we've seen home price gains in those Tampa area submarkets of 60% in total. Yes, 60% home price appreciation since that time. So if you put a 20% down payment on a property, that means you have had a 300% gain on your down payment, let alone all the other ways that you're paid with real estate investing, in addition to appreciation. And as you know, I've long championed investing in Florida here at GRE. I've done so much of my personal buying there the past few years. With today's guest, I think you're really going to like it because he's in another hot part of the country, a different Florida submarket. I'm going to ask him actually a couple questions that he probably hopes I don't ask him. So learn more about how real wealth is built in the real world with real estate. Your home for where this show comes from is at GetRichEducation.com. And if you ever want to jump straight to an episode, well, today is GRE Podcast episode 394. To get to the show notes and more, just simply jump to GetRichEducation.com/394. That's where you get the education with our blog and our other resources over there. And then if you're looking for properties, go to GREmarketplace.com. Set up a login there one time. Get access to all the providers where you find properties that are often conducive to our strategy here. One resource that you'll want from our GetRichEducation.com side is our Don't Quit Your Daydream letter. That is our super valuable email newsletter, and I write every word of that myself. Learn about real estate trends. If we resume field trips or other GRE events like the one that I mentioned in Tampa earlier, you're going to learn about it either here on the show and or in our letter. And we are growing. If you'd like a job opportunity with GRE, well, we aren't hiring right now, but 2 of our recent hires came directly from our newsletter readers. We've made GRE job announcements in this letter. And I'll tell you what, is this like the golden age of quality newsletters? I mean, how frustrated are you with news websites that are increasingly riddled with friction like paywalls and logins and banner ads and pop-ups about cookies? Well, instead, I deliver my wealth building newsletter directly to you. This letter is how a lot of readers found the best properties for their portfolio too. You can sign up free at GetRichEducation.com/letter. Although in the beginning, you'll get a series of value-packed welcome emails every few days. After that, you'll get our regular letter, and I send that about weekly, not daily. It is full of value. It's free of hype. It's just real content that makes a real difference in your life. Get it free at GetRichEducation.com/letter. More next. I'm Keith Weinhold. You're listening to Get Rich Education. Hey, my friend Damian Lupo informed me that checkbook IRAs have been made illegal by the U.S. tax court. If you have a checkbook IRA, your holdings are now disqualified with taxes and penalties up to 50%. But don't panic. Damian and the EQRP company can fix this. Those IRAs can be converted into EQRPs retroactive to last year, getting those tax deductions and reducing your taxable income. And this way, you can invest your 401k or IRA in real estate, Bitcoin, gold, and even your own business. So whether you're a full-time investor or retired or even a dentist with dozens of employees, if you're listening, you qualify, the EQRP works. It's a solution. You'll control your money, kill UBIT, and pay way less taxes. To learn more about this strategy and free up your retirement money, get the newest EQRP special report. Text GRE to 307-213-3475. That's text GRE to 307-213-3475. The people that our listeners can't stop talking about are Ridge Lending Group, NMLS 42056. They've provided GRE listeners with more loans than anyone, and it's where I got my last few loans. They finance single-family income property up to 4plexes. They're the #1 lender for beginners and veterans. Start your pre-qualification, chat with President Shaylee Ridge personally, and get your custom plan for expanding your cash-flowing portfolio. Start at ridgelendinggroup.com.
This is the Real Wealth Network's Kathy Fettke, and you are listening to the always valuable Get Rich Education with Keith Weinhold.
I'd like to welcome back to the show the co-founder of JWB Real Estate Capital in Jacksonville, Florida. They serve out-of-state investors like you, unless you live in Florida. In fact, it's now more than 1,300 clients in 49 states and 13 nations that they serve, over $750 million in real estate assets. Gosh, I feel like the next time I have you back, it might be that big 1 billion number. And the businesses they work in are predominantly turnkey rental properties and private lending. And they've grown to more than 80 full-time employees now. When I first visited their Jacksonville offices in person, they were somewhat smaller, and they've won so many business awards, and they're really so involved with giving back to the Jacksonville community. And here is the man who helps lead it all. Welcome back to GRE, Greg Cohen.
Thanks, Keith. Thanks so much for having me.
Greg, you're now the top residential home buyer in all of Northeast Florida. You were doing new build turnkey properties before just about anyone else was. So you're really visionary there. Real estate is hot. Build to rent is hot. Florida is hot. Jacksonville is hot. So tell us what you think an investor in this hot market needs to know today, Greg.
Well, I think this is a really special time as an investor. I think this is a time where you've never had stronger signals of what is going to happen in terms of interest rates and home prices over the next year. Knowing those signals, along with the fact that there is inventory, if you work with the right team available for you, those investors right now can take advantage of these interest rates and of these prices and actually acquire inventory today and set themselves up for generational wealth. Because in the past, you might have had inventory, but you didn't always have the signals of what was going to happen a year from now. But when you see prices going up and you see interest rates going up, the ability to lock in long-term debt, the ability to hold an asset, which is an inflation hedge as well, and then the ability to take advantage of price increases, which we expect over the next 12 months, is really, really special.
I still can't identify a better alternative to investing in real estate. And I think for an investor today, there really needs to be a sense of urgency behind getting out of dollars. If you would have put $1 in your wallet 1 year ago, it would only be worth about 90 cents today. A lot of people feel like the real rate of inflation is understated. So that's 90 cents today. And if you don't do anything about that, that's only going to have 80 cents of purchasing power 1 year from now. So that's really the compelling motivation to want to get out of dollars. When we talk about alternatives, well, you can look at stocks. Some people feel they're overvalued on a price to earnings ratio. Bonds, I mean, come on, their yields are only a fraction of stated inflation. Gold and cryptocurrency, they really haven't risen much with the inflation, importantly. So I really don't know that there is a better alternative to investing in real estate.
You and I agree. And I felt this way for a long time, but right now it is more clear than in times in the past because of that inflation hedge. When inflation happens, inflation is a thief. It erodes our wealth. And in inflationary times, you want to be invested in hard assets. And there are a number of hard assets out there. Real estate isn't the only hard asset. But when you combine investing in hard assets that tend to go up in value with inflation, in terms of rent prices and home prices. We're seeing that in rental properties. But you add that component along with that amazing component of being able to take out smart debt on that asset. Even if there are other assets, hard assets out there, the debt isn't as advantageous as it is with rental properties. And when you take out smart debt on a hard asset in inflationary times, Keith, you know what? I know you coined what this is. What's it called when you win three ways and beat inflation? It's called what?
Oh, it's the inflation triple crown. We love talking about that around here.
Absolutely. I think that inflation triple crown, if people can understand that now more than ever, again, this is so much more valuable even than it was 3 years ago, 4 years ago, because it increases in value as the CPI increases. As the rate of inflation increases, your knowledge of the inflation triple crown and how to take advantage of it is all that more important. So I agree with you. And you talk to a lot of experts. I hear of a lot of experts on your show, and you ask them the same question. You say, well, where should you put your money other than a hard asset where you can take out debt? And nobody really has the answer out there.
There are a few interesting ways of thinking about this, Greg. I often espouse in inflationary times, you want to get out of dollars and into real assets and debt, to your point. Now, for example, if someone goes and pays all cash for a primary residence, well, let's say the real rate of inflation is 10%, and that primary residence should, in theory, hold its value with depreciating dollars. So therefore, it's really just an inflation hedge. When we talk about the inflation triple crown, you're not just hedging against inflation, you're actually profiting when you put a down payment on rental property rather than all cash for a primary residence. Now you've leveraged inflation to multiply your appreciation, the first leg of that inflation triple crown. So you're inflation profiting now because you're leveraged. Secondly, you're inflation profiting on the long-term fixed interest rate debt as inflation debases your debt as the tenant makes those payments for you. And then the third leg of the inflation triple crown is positive cash flow. Positive cash flow, though, has become more difficult to get. Now, your cash flow should outpace inflation over time because your biggest expense as an investor is fixed, that mortgage principal and interest. So in some places, though, the cash flow has evaporated because in the past year and a half or so, prices have run up faster than rent. So can you talk to us about what you're seeing there in Jacksonville? Are you concerned about cash flow going away? Tell us about that.
Cash flow is going away in Jacksonville and in all parts of the country. If you look at what cash flows are today versus what they were a year ago or 3 years ago or 5 years ago, it's much less than today. But here's why I'm not concerned about it. So I started to invest in 2006. And the first books that I ever read talked about how real estate was the foundation of most wealthy Americans. And the goal of the books that I read in the beginning, these books, again, were written in the 1990s. The goal was to buy rental properties that paid for themselves every single month. And that allowed you to benefit after holding on to them for 10 years, 15 years, or 20 years to the point where you could control your own time and achieve financial freedom through those rental properties. These books weren't talking about cash flow. They weren't talking about positive cash flow. And I always remembered that. And as I started to buy my own rental properties, I bought about 40 rental properties in 2006 and 2007. Before the crash happened, I realized how important, how amazing cash flow was. I was like, these authors know that you could actually get positive cash flow. Why didn't they include this in their book? So I invested for positive cash flow, but I also invested in a growth market where I could take advantage of those other 4 profit centers as well. And as the market crashed from 2007 to 2011, I still held those properties. And I realized how important cash flow was as a risk mitigator because it allowed me to mitigate risk. As I have held those properties since 2011 till today, I still own those properties and I've added about 300 more to our portfolio. I fully understand the power of all 5 profit centers. The foundation of my financial freedom is not the cash flow from those 300 plus rental properties. It certainly is nice, but the foundation of my financial freedom is all 5 profit centers. The reason why I'm not concerned about cash flows going down is because really there's nothing we can do about it. It's market dynamics and prices are going up and interest rates are going up, and that's what's going to happen. And the other part of it is that you never needed positive cash flow for this investment to make sense compared to your other alternatives. When you combine all 5 profit centers and you compare how hard your dollars can work for you compared to stocks, bonds, mutual funds, other asset classes, this asset still wins the vast majority of the time. So I've always thought the cash flow was nice to have, but it was never the only reason to invest. And I've been very contrarian to what most turnkey rental property providers have said for a long time. That's just what I've been living. It's nice to have when we have it. And for the last decade, we've been really blessed to have incredibly low prices and incredibly low interest rates. And sure, positive cash flow has been nice to have, but you have to see beyond positive cash flow. And what's going to happen over the next 1, 3, 5, 10 years is that investors in rental properties are now forced to understand all 5 profit centers. Because if they don't, they're probably not going to make wise decisions.
If you're a new listener, so that you're keeping up with this, I was discussing the inflation triple crown earlier about how when you buy a property with long-term fixed interest rate debt, you profit from inflation 3 ways at the same time. Greg and I are now talking about another concept that I coined years ago, how real estate often pays you up to 5 ways at the same time: appreciation, cash flow, principal pay down, tax benefits, and this inflation profiting benefit, which presides over the inflation triple crown. Greg, sometimes I get this international perspective, really someone like standing outside the box that got to look at the opportunities that we have had as United States real estate investors for years. I'm talking particularly about this friend that I have in Australia. He's a pretty prominent entrepreneur and real estate investor. And when we talk about cash flow, we're often looking through at the perspective of, well, can you get cash flow with a 20 to 25% down payment? Oftentimes, foreign friends can't believe that we've had this opportunity available to us where with just a 20 or 25% down payment, we've been able to get cash flow. And we've been able to tie up 30-year fixed rate mortgages all this time. We're talking about advantages with good property rights that you can do in exceedingly few places in the world. So my point really is cash flow in existence or not? What if you make a 50% down payment? You still got 2-to-1 leverage and you've generated cash flow. I'm not saying that's ideal. I'm saying that I've got the big picture perspective. When you talk about what the alternatives are, real estate investing that generates an income stream tied to long-term fixed interest rate debt still has multifaceted advantages that are just unparalleled anywhere else.
It's amazing. After listening to your segment, it was a number of segments, maybe a couple of months ago, 3 months ago, but we talked about how this debt that we have in the US is not available in other countries. And then I did my own research and I was like, oh my goodness, we don't know how good we have it here. And the simple question I always ask people is, let's say that you can borrow at 5% rates right now, and you can keep that in place for 30 years. Do you, as an educated investor, believe that you can earn more than 5% on your money? And for those listeners of GRE, they should all say yes, because you're doing a wonderful job, Keith, of showing people how you can earn more than 5% on your money. Well, then, do you know how valuable it is for you to compound that arbitrage, right? That money that you're making on that money. Do you know how powerful that is to do over 5 years? If you earn 10% and you borrow at 5%, you earn that 5% spread over 5 years. That's incredible. Can you do that over 10 years? Look at it over 20 and 30 years. That is how you create generational wealth. That is why most wealthy Americans have a strong foundation of real estate in their portfolio. And it starts by understanding smart debt. I mean, real estate without smart debt is not the home run that it is. That just plain and simple. So I'm as passionate as you are about teaching folks about using smart debt and about keeping that debt in place. I love your tagline. You'd rather be financially free than debt free. I'm with you every step of the way.
Financially free beats debt free. So when we talk cyclically about markets, we have seen appreciation rise faster than rents can keep up with. And historically, we do see this happen. There is this lag time. I've been investing in income property directly since 2002, longer than a lot of people have. I started really young. I saw it happen back then in the price run up from 2000 to 2006, 2007. Prices ran up. Rents didn't keep up proportionally to that price run up of property until we had the global financial crisis prices when rents caught up, because rents didn't go down then when prices did. But over the long term, cyclically, it takes some of that lag time for rents to catch up, for some of those cash flows to return, because we've seen downward pressure on profitability, downward pressure on cash flows, downward pressure on cap rates. Speaking there more specifically to Jacksonville, the market that you're in, which is historically an advantageous market, tell us about some more of the fundamentals there.
So in Jacksonville, over the last year, I don't think there's been an asset class out there that has benefited more from the COVID economy than single family rental properties in Jacksonville. And I say that because, number one, rent collection has been incredibly high for single family rental properties. If you ask most property managers, they collected much higher percentages of rents than they would have expected early on in the pandemic. Our rent collection all the way through 2020 and through 2021 came in at 98% because of this asset class and because our clients are investing in a critical need. It's a critical need of housing for that resident who needs that home. And it's a critical need for the government to make sure that housing is working well, as we saw with a lot of the stimulus aimed at helping people stay in their homes. So number one, we have seen very strong performance in uncommon times because of this asset class and in Jacksonville. But the other part of this is, and the reason why I believe there hasn't been an asset class or a market that has benefited more than Jacksonville, is because of the incredible rents and the incredible price gains. So in Jacksonville, year over year, we've appreciated roughly 20% from last year to this year. That's on the pricing gains. On the rent side, we've appreciated a rate of 10.5% for the overall market. Those numbers are both really beefy. I've been investing for 16 years here. I've never seen those types of gains, and I don't think I'll ever see those types of gains again, especially in the same year. So it's been an incredible time for rental property investors. What we're going to be seeing going forward is, especially this year, we're expecting to see higher than normal home price appreciation again. And we're expecting to see higher than normal home rent price appreciation again. The reality is that we have gone up so much over last year, year over year, 20%. And this year we're expecting higher than normal again. People might say, well, how can that be possible? It's possible in Jacksonville because of a couple of things. Number one, we're an affordable market. If this was San Francisco, this would not be happening, just simply because people could not afford homes. Here in Jacksonville, people can. Over time, we'll figure out how sustainable this is. The higher the run up, the higher the chance for a correction, but we're not there yet. Where we are right now is we have less inventory on the market today than we had 1 year ago, and lower inventory and higher demand from people moving to Jacksonville. And because we still have low interest rates, is resulting in extremely low months of inventory. And that's a very strong indicator of what pricing is going to do over the next year. Just to put it in perspective, I was investing in 2007 when we had 18 months of inventory. Historically, equilibrium is 6 to 7 months of inventory. 18 months of inventory is so much higher and would lead you to believe that you're going to see lower than normal home price appreciation.
Right.
Well, now, today, we have 1 month of inventory in Jacksonville. Lower than 6 to 7 months of inventory would lead you to believe that we're going to have higher than normal home price appreciation over the next 6 to 12 months. And 1 month of inventory is the lowest I've ever seen it. And the way that this is going to get back to equilibrium is when builders build in mass. You are not going to get to the number of supplied homes on the market by your neighbor or your neighbor's neighbor deciding they want to put their house in the market. Builders are coming in because they see an opportunity and they are building as much as they can. But it's taking longer today to build homes than it ever has in recent history because of all the challenges with supply chains. And so it just simply is not going to happen fast enough this year. And especially in an affordable market like Jacksonville, you're going to see higher than normal home price appreciation because you're still going to have low supply until all of these housing communities come online. And eventually it'll get closer to equilibrium. And eventually home price appreciation will tamper down and become more normal. But I just don't see it happening this year.
Yes, this dearth of supply is an inelastic condition like I've characterized it. We're just not going to be able to bounce back up out of it anytime soon. And it's funny, in a lot of industries, you can look at sales numbers to see what's going on in a market. If window glass or vases, if the sales of some of those produced items are low, then I guess there just isn't much demand for it. Well, there aren't very many homes produced, meaning oftentimes sales, the number of sales are down just because there simply aren't enough homes on the market. You can't buy what's not for sale. And there specifically in Jacksonville, of course, you have a number of important drivers. It's a low cost of living sort of place. It's a warm place. That's attracted a lot of Northerners. We all know and understand that. And then specifically in Jacksonville, Northeast Florida, there you have such a busy port. A seaport is such a long-term sustainable economic driver, and they're the types of jobs that cannot be outsourced elsewhere. So it's drivers like that that really help Jacksonville. Greg, do you have any other comments about the market and the drivers there? And then just specifically how you help investors get started with properties?
I did a little bit more research on population growth as a driver because our population is exploding here. A lot of this has been taken note of after COVID hit and pandemic and whatnot. But I started to do some research prior to the pandemic. Where did Jacksonville stack up because of some of these big economic drivers like the port? From 2017 to 2019, Jacksonville was the 5th fastest growing MSA, which was surprising to me. 5th fastest. I looked at some of the other cash flow markets out there and compared population growth. Jacksonville's population growth was 3.6% compared to the national average of 1%. And this is coming from the US Census.
And that's pre-pandemic.
It's pre-pandemic, before all of this. And we, of course, know that Jacksonville and the state of Florida has been a hotspot of migration. Many other cash flow markets have somewhere around 1% population growth or lower, which would make sense because when we talk about cash flow markets, people tend to go there for cash flow, but they tend to give up on growth. Jacksonville is a market where you can get both. They're really, if you do the research, I don't think you're going to find another market out there where you can still get positive cash flow, but you can have 3.6 times the rate of population growth of the US overall, and probably higher than that once the data comes back. You look at population growth in those markets that tend to appreciate higher than the national average, they tend to have higher than normal population growth rates as well.
Well, Greg, I am going to finish up by asking you a question maybe you would hope that I would not ask you. That is, what does your inventory flow look like? And before you deliver that answer to us, if you want to learn more about what they do for you there in Jacksonville with turnkey properties in helping you with oftentimes a new build infill lot property and making that experience turnkey for you, helping you close on the property, managing it for you, getting a tenant in that new build property. Over there at GRE Marketplace, you can click on Jacksonville or just go directly to gremarketplace.com/Jacksonville. Greg, tell us about that very difficult question. How is your inventory currently?
We are one of the very few providers that has never gone on a waiting list. We have been able to serve all of our clients that have been purchasing rental properties with us really since the beginning of the pandemic and before that. So we actually have never gone on a waiting list, but that is not to say that I don't expect us to at some point. Our sales have almost doubled year over year from last year to this year, and we are building as many houses as we can. But if I look in my crystal ball and see our months of inventory, at some point, sales are going to outpace homes that are built. For now, we do have inventory. There is no waiting list, but I've been sharing that I do expect a waiting list to come. We will have to, unfortunately, do that, which is the normal way that people are buying properties right now. And no matter which providers you work with out there, you largely are seeing a waiting list. Or if you're buying it the old-fashioned way with a real estate agent, you are waiting a long time to buy a property. As of right now, there is no waiting list. We have more than enough inventory to serve, but I would imagine probably by the time this podcast comes out, there probably will be one in very short order. Now, the great thing is that for a waiting list, when that does happen, it's going to be a very smooth and easy process. We always onboard clients rather slowly. It's usually a few weeks of a conversation to make sure that our goals are aligned. So it's not an easy as an answer as you've asked me in the past, Keith. I've always been able to go really strong and say, we don't have a waiting list and I don't anticipate one. Well, today we don't have a waiting list. At some point in the near future, I expect that we will. And it's just the natural state of supply and demand and across the real estate landscape right now.
I toured your offices in person in 2017, and I remember remarking at how I was surprised at that time that you had dozens of new construction turnkey properties available, and I toured one of those at that time. And today you are just a magician to continue to pull that off. That just is a testament to how you have really so many relationships in the community there, because you have invested in the community yourself in so many ways. If you want to learn more and get started with, yes, actually available property in Northeast Florida in that Jacksonville MSA, you can do that at gremarketplace.com/Jacksonville. Greg, any last thoughts?
I just have appreciated our dialogue and our conversation, our friendship for so many years, Keith. It's really fun to see the market take so many different directions over the 5 or 8 years you and I have been working together. And it just goes to show that this real estate thing is cyclical. I look at every single time of the market that we're in right now, and there's an opportunity, and there are things that are more difficult. And it will be that same way in 5 years from now. It'll be 10 years. It just goes to show how important it is for listeners to listen to experts like you, Keith, because if you learn about what state of the cycle you're in, you'll be able to take advantage of those things that are really going to be able to create a lot of generational wealth.
It's been valuable, Greg. Thanks for coming on as always.
My pleasure.
Thanks. Greg is a great guy, and he is the man to know in Jacksonville real estate. He's the one to know in Northeast Florida. And notice us being rather agreeable there. He's a regular GRE listener. A lot of the best national property providers are. Yeah, how do you think they all stay so well informed? Well, of course, that's only because they listen to GRE. With the values of almost every asset class run up today, I think it's at least worth asking yourself the question, gosh, would this property cash flow if I make a 40% down payment rather than the minimum necessary 20% down payment? Now, that is definitely not ideal. That cuts your leverage ratio down to a 2.5 to 1, but it's at least a question to ask. Well, I don't know what to tell you other than that if you want some income property, you've heard that there's no waiting list in Jacksonville at this moment, and there is inventory right now. Understand that this is one of the most listened to real estate shows in America, so how long do you think that's going to last? That available inventory is a testimony to what they do there. When I was first inside their Jacksonville office a few years ago, I learned that part of their formula to keeping inventory available is how they take a long-term view and buy up vacant lots for building on them far ahead of time. If it sounds like a helpful resource for you, you can get the report and see some sample properties there and get started in Jacksonville. You can do that at GRE Marketplace, or just go directly to gremarketplace.com/Jacksonville. gremarketplace.com/JAX is a little shortcut that takes you to the same place. Until next week, I'm your host, Keith Weinhold. Though you might quit your day job, don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.